So we know that the stock market over time goes up in value, but the truth of the matter is at times the market can drop significantly. To be clear, there's nothing wrong with just holding onto your shares of the S&P 500, the NASDAQ 100, whichever index ETF you use, and just riding through the storm, knowing again that the markets will come back up as they've historically always done. But is there a way during these turbulent times when volatility is really high, is there a way for us to actually realistically protect our portfolio from dropping significantly? You know me, I'm a data guy, so let's test it. What's up, you guys? Welcome back to the Average Joe Investor channel. In today's video, I want to talk a little bit about protecting our portfolio, particularly when we have significant value built up. I'm not talking, when we have $20, $30, $50,000 saved, but perhaps when we have hundreds of thousands, maybe even a $1 or $2 million portfolio. And we want to protect it. We want to avoid some of the turbulence that does in fact occur at different times. Now, through diversification, we could utilize things like bonds, or we could use T-bills, treasuries, etc. to give us a little bit of protection from volatility. But I'm a big believer in holding the actual stock market and index ETFs for the long term and with the majority of the portfolio. So particularly in this video, we're going to talk about S&P 500 put options. So if we own the S&P 500, can we utilize protective puts, meaning purchasing put options, which would in theory increase in value as the market goes down? Can we use these on a recurring basis to actually protect our portfolio from going down in value? Naturally, I built a spreadsheet. So let's dive in. Okay, so what you're looking at is a spreadsheet that I built with some data that I got from Market Chameleon, which has some great option backtesting software. I can go back up to 10 years and look at what the actual historical values were for different types of option contracts. So what I did was I assumed that we had a portfolio of about $200,000. Okay, this would apply to 500,000, a million as well. You would just need to scale up the amount of options that you were utilizing. Now the assumption is that back, let me go over here to the price here. So what I did is I looked at the past 5 years of the S&P 500 and looked at a time where we had a continuous downturn for a little bit. And I identified right here, 2022 to 2023, this trend right here. So it looks like the price was right around 475 in beginning of January 2022. And here at the end of 2023, the market was around, I don't know, 380, 390 per share. And I figured this might be a good test period to say if we had purchased the S&P 500 and purchased some protective put options right in this area right here, how much value would we create and how much protection would it give our portfolio if we held those put options from here to here. Now, as a quick reminder here, when you're purchasing protective put options, it is costing you money. So when you purchase these put options and the market goes up in value, you're going to be losing money on these specific put options. And in theory, if you were to hold them for a year and then roll them out, then at that point you would incur a loss and it would be pretty significant, but you wouldn't have a total loss of the option value. So we're going to hop over to the data here, and here are my assumptions. I assume that we used all $200,000 available here to purchase shares of the S&P 500, ticker symbol SPY, and at that time, given a share price of $477.55, I was able to purchase 418.80 shares. So my assumption here is if I've got 400 plus shares, I should purchase 4 contracts of the S&P 500 when I try to protect the portfolio. So let's see how that worked out here. So 4 contracts of the SPY put options. So this is the historical chain, January 3rd, 2022. And I'm looking at the furthest dated expiration for the option contract, which would be December 20th of 2024. So about all of 2022, all of 2023, all of 2024. So pretty significant gap here on time. So we've got 3 years there. I went out furthest expiration and I went with an at the money put option, meaning I'm protecting my portfolio at the current price. Then I also looked at an out of the money, which would be 460, right, which is about $20 per share below the current market price. And then I looked at also $20 above, which would be in the money, right? So assuming that the market's trading at 480, if I've got protection at 500 and below, that's what I would call an in the money put option, just to see how these would actually change in value given the trending down in the S&P 500 during this time frame. The S&P 500 was at 477.55. So fast forward to the end of the time frame, which is 1 year later. We're going to look right over here. We've got on January 4th, 2023, about a year and 1 day later, the market price for S&P 500 is $383.75. So about a $100 per share drop in the value of the S&P 500. And we're looking at these same contract values, 460, 480, and 500 on those strike prices. And if we actually go back over here, before we look at those values, we can see here that we've got at the money, in the money, and out of the money. So the market price was 480 at the time-ish. So 480 is at the money, 500 is in the money, and 460 is out of the money. And here's the cost of those put options, which are pretty significant if you ask me. You've got the at the money put option would cost you for 4 contracts in total $26,400. That is this number right here, the bid and the ask, times 4. So about $6,500 times 4. Then we've got in the money, which is going to cost more because it's in the money. That's going to be at right here, $7,450-ish times 4. So $29,800 for protection for technically 3 years of protection. But we're going to roll this contract after 1 year. And then the out of the money contract right here, which gives us protection at 460 and below, would cost us a total of $23,400. Now, my first thought here is looking at the value of these put options. They're pretty expensive. So my thought is I'm hoping that after a year goes by, if the market is dropping, meaning the time when we really need put options, are we getting sufficient value out of them? Are they increasing in value enough to justify this cost? Because remember, if the market's going up in value, then a lot of the value of these contracts are going to be sunk costs. So you'd really need the market to move up quite a bit in order for them to have real, genuine value. Okay, so moving back over here, fast forwarding to January 4th, 2023, we have the 480, the 500, and the 460. And they've gone up in value, which is good. Before we look at the change in put value here, let's take a look at what happened to the value of our shares. You'll see here that our shares, remember, were originally worth $200,000 at the time we bought them. And they declined in value by $39,285.50 over that 1 year. 1 year later, they're worth about $160,000 in value instead of $200,000. So the question is, did these put options, did any of those different at the money, in the money, out of the money, did they actually increase in value enough to cover the value of the shares? Let's take a look at the put option value. So you see here, at the money went up $12,400, whereas the in the money went up by a total of $15,000, and then the out of the money went up by $8,800. So as you can see here, none of them went up by a sufficient amount in order to actually offset the drop in the value of the shares. And if you look right over here, you'll see the net effect on the portfolio. Instead of being down $40,000, we were down $26,000 with at the money, $24,000 with in the money, and then out of the money was still down $30,000. So we had a maximum maybe a 25 to 30% benefit. To be honest, I wasn't really thrilled with these results. I really was expecting a little bit more bang for our buck if we're going to spend that much money on SPY put options. Well, then my next thought was, well, maybe if we had not held the contract for the full year, perhaps if we had taken action on those put options, maybe bought them back, maybe sold them for a profit earlier in the year, maybe we would get a little bit more value when the market was down lower. So I went ahead and tracked the value of these contracts at the 3-month, the 6-month, and the 9-month mark to see where the best bang for our buck was in capturing that value. Okay, so here is that tracking right here. So again, we've got the original values just like we saw up here. But after 3 months, the value of the S&P 500 had gone from 477 down to 456, which is a real loss. But you'll notice that these contracts, nothing much happened with them at this point. We had lost a little bit of value on the at the money $800. The in the money had lost only $200, and the out of the money had lost $1,000, which is fascinating. So even though we were seeing a drop in the value of the shares, no real change in the value of our put options just yet. This is after 3 months. After 6 months, that's when we have a significant drop here. We went from 477 down to 456, and then from 456 down to 381. Now at this point, all of our put options had increased in value. The at the money was up $14,800 over its cost. The in the money was up $18,000. And the out of the money was up $11,800. Fast forward to 9 months, the market price had gone from 381 again down to 377. At this point, the values had gone up again on our put options. $15,600 up on the at the money. The in the monies were up $19,800 in total. And then the out of the money was up $12,400. So down $800, up $14,800, up $15,600, and then at the end of the process, it was up only $12,400. So here's this data graph. By the way, I've got all the screenshots. I'm not sure if you saw those here. So we've got the beginning screenshot for 2022, the ending screenshot from 1 year later, and then we also have down here the screenshots at 3 months, 6 months, and 9 months, which is where I got my data. Here's that data graphed compared to the actual price per share. So in blue, we have the share price. And then in red, we have in the money, yellow, at the money, and then black, out of the money for those put option contract values. So you see here, we have a drop from here to here, and there's really no change in these put options. Then we see obviously an inverse relationship between the share price and the value of the put options, which is what we expect. We've got the drop from right here around 450-ish down to 377 approximately. We have a significant drop here and a significant increase right here. And then we have leveling off. So at this point here, my thought process is the best time to actually have taken action on these put options would be right here in the 6-month range. And of course, at this point, we don't know what's going to happen. We didn't know that the market's going to level off here, but still right here after 6 months, we only have a much smaller portion of the extrinsic value of these put options that has been drained out after 6 months. We have even more leaking out after an additional 3 or 6 months, this time frame right here. We had no change in our put option value, actually a slight decrease here, but we also have eroding time decay in these purchased put leaps options that we have. So it seems like the best time would have been to lock it in right here. Now with that extra income, that extra value in the put options, what you could do, this might be the magic in this type of strategy, is right in this range right here to then turn around, take that money and either buy more shares of the S&P 500 or splitting that in value between purchased shares as well as purchasing leaps options for the future. Not the put options, but the actual call options. Now this was only one time frame in the S&P 500 from 2022 to 2023. And to be fair, I do need to do a little bit more testing to see how it affects other time periods as well, but also other variations of how we could structure this strategy to make sure we're getting maximum value. It seems like you do need more put options to actually give proper protection to the portfolio. And I definitely want to see if there's other ways to structure this strategy on when to actually take action, how to potentially lay out these types of put options, and how to maybe potentially roll them over at different times or roll them out to a future date to make sure that I'm not losing too much time value by holding them for too long. So more data to come here. I'm definitely not convinced at this point that actually purchasing these types of put options adds a ton of value, especially if you are segmenting your portfolio into income, into growth, into cash. So that way, when these drops in the market do happen, they don't impact you whatsoever when it comes to how you collect income. And then you can allow those shares to recover significantly and grow exponentially with purchasing leaps options, leaps call options into the future. Access to this spreadsheet and all of my other spreadsheets are available to you if you join the Average Joe Investor Patreon community. So if you want to learn more about doing that, make sure to check out the link down in the description below. We've got tons of value there. We've got an amazing community of DIY cash flow investors. We've got daily office hours with Joe where you get access to me on a live call just to talk through whatever you want to talk about. So there's tons of value there. Again, check out the link down in the description below. Also, make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I upload new videos. I always want to hear about your questions, your concerns, your feedback about the videos I make, and future ideas you have as well. That's all I got for you guys. Have a great rest of your day, and thanks for watching.